Let's get straight to today's market rally. Joining us now is Vital Knowledge founder Adam Crisafulli. Adam, great to have you on. I mean, S&P closing at 44.97, just below 4,500. I think the big takeaway is you had some softer data this morning, particularly JOLTS. Yields moved lower, stocks moved higher. Do you fade this rally?
I think it has a little bit further to go in equities, but I don't necessarily see us hitting fresh new highs just yet. I think, the JOLTS report, like you mentioned, was a critical piece of information today. It's the most important event of the session, drove a big rally in treasuries. This is the second kind of data shock that we've received now in less than a week after the flash PMIs from last Wednesday. And so obviously lower yields are positive for stocks, but I think we have to be careful about what's driving yields lower. To the extent it is a resumption of the disinflationary process, that's going to be positive for both treasuries and stocks. To the extent we start to become more concerned about growth, which is my fear, I do think you're going to start to see a little weakening in growth momentum in the coming weeks and months. I think that you're going to see a divergence then in treasuries and equities. So I think the S&P has a bit further to go in terms of the rally, but I would be fading it in about 50 to 60 points or so.
Got it. And then what would you be doing? Buying treasuries?
I think the Treasury rally has a little bit further to go. I think, what you saw with the JOLTS today, part of it has to do with technicals, too. The Treasury sentiment was extremely negative. And so I think, to the extent we see further data disappointments, it's going to help Treasuries a lot more than upside data reports is going to hurt them. So I think Treasuries have technicals on their side from here, whereas equities don't really have that much of a positioning or sentiment tailwind at the moment.
Okay, so if you're at home and you're looking at your portfolio, we're right about in the middle of the August range of highs and lows. So if you don't have enough cash or equivalents on the sidelines, what would you say you sell here? And if you have enough, or maybe even a little bit too much, how do you get into the equity market when we are where we are right now? And I don't mean necessarily tomorrow or next week, but throughout the rest of the year.
Yeah, I think some of your yield sensitive names, so some of the areas of the market that have elevated yields that are more sensitive to movement rates, I think those groups could outperform if you do see a sustained rally in treasuries. So I think those are some of the more interesting areas now going forward over the coming weeks and months, because I do think you're going to see a little bit of a weakening in some of the growth data going forward. And we have, a ton of more data left this week, including the ADP jobs report for tomorrow. You have the PCE on Thursday. You have the jobs report on Friday, plus the Eurozone CPI too. So you have a lot more data this week that's going to be crucial for how treasuries play out going forward.
A couple of people have said to me, in their opinion, wages in particular, this jobs report get more weight. They just matter more. What do you think?
Yeah, no, I think wages are very important. I also think too, what we've seen for the last several quarters is phenomena of shrinking work week. So you have the hourly wage number has held relatively steady, but the work week is shrinking. So total take-home pay, as measured as hours times wages, that number has been coming in. And so I think that's really the crucial one to watch. Companies are very reluctant, I think, to wholesale cut headcount, just given how the difficulty they had over the last several years of finding people. But they are shrinking work weeks. They're cutting back on the hours worked as kind of a stealth way to rein in some compensation costs. So I think that's going to be the key, is the wage times the work week length for this Friday morning.
Yeah, and of course we know wages have been sticky. There's been a lot of labor negotiations and the like that are potentially going to add some noise to this report in particular. Assuming that this disinflation narrative continues to persist in the market, based on the data we get in the coming days, from a stock perspective, who stands to benefit? Because I know you've talked about this on the program before, but this idea that it's a double-edged sword.
Yeah, so I think you're going to see kind of the evolution of disinflation is going to shift. So we're moving away from pure base effects from commodity prices onto you're going to see more disinflation in services, so especially shelter and housing, but other parts of services as well going forward. So you're seeing retailers call out disinflation as one headwind. You've seen a lot of retailers talk about increased price promotion. So that sector of the market is already feeling some headwinds. But I think more services areas in the second half of this year and into early next year could start to see some more disinflationary pain, just given that they're coming up very, very difficult compares, just given the enormity of the price increases for the last several years.